Good morning, ladies and gentlemen. On behalf of the Jamaica Chamber of Commerce, let me extend a warm welcome to all our participants online, on YouTube. My name is Andre Gooden. I'm a director of the Jamaica Chamber of Commerce and chairman of the Jamaica Conference Board. And we welcome you to the release of the third quarter Jamaica Chamber of Commerce Business and Consumer Confidence Indices. The last quarter's results presented us with a mixed bag, really, no better and no worse than the quarter before. And it did keep us quite spellbound in terms of trying to do the analysis of what the consumer and business sentiment was exactly. So we will see what happens now with the third quarter, which ended on the 30th of September. I'd like to specially recognize our sponsors, National Commercial Bank and NCB Capital Markets, and to our presenters from NCB, Dr. Leo Ray Gordon, Head of Economic and Financial Research and Analysis, and Mr. Timar Jackson, Assistant Vice President, Origination and Structuring for NCB Capital Markets. Of course, good morning and welcome again to our main presenter, Mr. Don Anderson, Managing Director, Executive Chairman, beg your pardon, Market Research Services Limited, and to our very distinguished panel who will join us in the discussion, Dr. Marlene Street Forest, Managing Director, Jamaica Stock Exchange, frequent panelist, and we're happy to have her here again. Mr. Marcus Richards, Executive Chairman, Argyle Industries and Managing Director of Hardware and Lumber, and Mr. Solomon Sharp, Chief Executive Officer, Main Event Group Limited. The program really will be that we will have two short presentations, one from Dr. Gordon, one from Timar Jackson from National Commercial Bank and NCB Capital Markets. Our main presenter, Mr. Anderson, will then present the third quarter confidence indices release. We will see a short vox pop video from John Q. Public as to what their own take is on what's happening business-wise and how they are coping. And then our panelists will weigh in on the results and how it is affecting their business and their own thoughts as to what the future holds and what their strategies are for survival and continued prosperity in this market, in this uncertain market, I must say. We will have, during that time, opportunities for question and answer. I will ask the persons online who have questions, you can post them in the chat, in the Q&A, beg your pardon, and we will take as much of them as possible. The ultimate objective, of course, being to ensure that everyone online understands where we are, business and consumer confidence wise, and the strategies to employ with your own personal business management, and of course the businesses that you run, to continue to negotiate the hurdles presented by the economy. So without further ado, we are thankful, of course, that you're all here, and we will now ask our first presenter, Dr. Leo Ray Gordon, Head of Economic and Financial Research Analysis at National Commercial Bank, to bring his remarks. Good morning, sir.
Good morning, Mr. Gooden. Good morning, Mr. Don Anderson, Dr. Marlene Street Forest, all of the fellow panelists, and greetings to the audience watching live and delayed over the internet. Are you seeing the presentation?
Yes, sir.
Good. Well, the theme for today's session is Road to Recovery. Where are we now? My view is that Jamaica has bounced back from the shock associated with the pandemic, and many of our regional neighbors are on a similar path of recovery. I've been allotted 5 minutes, so I'll try to stay within that budget. At the last quarterly meeting, a review of the current economic conditions was provided by NCB Capital Markets. At that time, it was highlighted that the main developments were associated with inflation, and the factors influencing its level were described. These included global supply disruptions in food and other items, and the cost of energy. It was further detailed the implications for capital markets to include higher interest rates, a compression of margins for companies, and a general shift towards equity financing. Today, those conditions are largely unchanged, so I won't re-describe them with any detail. Suffice it to say that the short-term outlook is still characterized by elevated inflation for Jamaica and its main trading partners. Monetary and financial conditions will therefore remain tight and perhaps be tightened even further by authorities. We're seeing revisions across the board on the global outlook, and these revisions describe a slower growth in the global economy and lower spending by households. I'm of the view that these financial and economic conditions will have a significant impact for Jamaica with some lag. The forthcoming business environment is one in which the wave of economic activity associated with the recovery will be subdued, and the new steady state over the next year will be akin to trying to remain buoyant in more stagnant water. Firms and consumers will therefore need to balance an environment of lower financial liquidity and a higher cost of funds. And operational developments associated with concentrations from the progress towards digital will be embedded. We do believe, however, that there are sizable opportunities within this impending environment for NCBJ and our customers. And I'll take the remaining time to highlight just a few of those. We expect domestic consumer spending to expand as employment remains stable. The employed labor force was 1.268 million at July 2022, approximately equal to the 1.269 million recorded right before the pandemic. When examining payments data provided by Bank of Jamaica, we see that the value of spend via point of sale machines was 14% higher over the first 7 months of 2022 compared to the equivalent period 2021, and was 26% higher than the same period in 2020. Further, credit card spend was 10% higher, and the value of transactions at ABMs was 28% higher over the first 7 months of 2022 compared to last year. Moving on, we expect that spending by consumers resident in major trading partners will also remain buoyant as they continue to release the pent-up demand after COVID lockdown. When we examine data from the US Bureau of Economic Analysis on the spend of international travel by Americans, their spending on travel increased by 38% over the first 6 months to April 2022. We see this translating positively to Jamaica's balance of payments, and more specifically to capital inflow due to the spend of foreigners. We are as well bullish on small and medium-sized enterprises. Based on data from the Planning Institute of Jamaica, we see where the number of MSMEs filing tax returns in 2021 increased by 7.5% compared to the year prior. Further, the small and medium-sized segment showed resilience during the pandemic during number, declining by only 3.4% and 2.3% in 2020, and subsequently increased by 12.1% last year. From this stability, we see persistence in their demand for financing. And finally, we believe that Jamaica and economies throughout the Caribbean will continue to demonstrate real economic growth. we estimate that Jamaica's economy will expand in the range of 2 to 3% in real terms over 2023. Thank you.
Thank you very much, Dr. Gordon. Comprehensive summary there, anticipating 2 to 3% growth in fiscal 2023. Looking forward to further developments in that area, and thank NCB Capital Markets and National Commercial Bank for their continued support. Now I'm going to ask Tamar Jackson from NCB Capital Markets, Assistant Vice President, Origination and Structuring, to add your own take on where we are as we go forward. Morning, Tamar.
Good morning. Are you able to see my screen?
Yes, Tamar.
Okay, great. So, thanks for the summary, Doc. So, I think much of what I'll say on this first slide is in line with what Doc would have indicated, so I won't spend much time. But suffice to say, the IMF is projecting that Jamaica will grow by 2.8% for 2022, which is in line with the range that Doc described just now. The main driver of this, of course, is going to be tourism. And this is primarily due to that pent-up demand, which was described earlier. We know that, in particular, that tourism is trending positively in Jamaica. And we're seeing that for the summer period in particular, that Jamaica reported its best performance in history. So it sort of goes to the story of the pent-up demand that we're speaking of. And I'll just look quickly at some of the other areas that are expected to benefit from what is going on with tourism. So manufacturing and construction, agriculture are expected to continue to benefit from the spillover effects. We're also talking about the construction sector, which we expect to see some level of fall off due to the higher interest rates. Low unemployment continues to be something that we observe, and this is buttressed by the reopening of the economy, job growth, particularly in sectors such as BPO, tourism, and so on, which would have been impacted previously by the pandemic. So I won't spend no more time on the economic matters, given that Doc would have done a very comprehensive summary. What I look at now is how the market looks trend-wise, relative to what I know Mr. Anderson will be speaking to later on. Generally, we find that the market sort of lines up with how confidence is, both from a business and consumer perspective. When we look at both indices, we see improvements locally, and I know Don will spend a lot more time on that. But for this quarter, we're noticing that the combined index, which measures broadly how the Jamaica Stock Exchange, those stocks listed on the Jamaica Stock Exchange, are performing as an aggregate, that would have fallen off slightly by 5.6% during the third quarter. So generally, what we have observed on the ground is that there are some stocks, especially larger stocks, that would have seen some level of pullback. There have been a few IPOs that would have been successful, but those are on the junior market side. So they have lower weighting than those larger stocks that would have seen the pullback. Generally, too, with interest rates being very high, what we find is that persons are moving some of their funds into shorter term, more liquid assets that are fetching very high rates of return over shorter periods. So those are just some of the factors which are impacting the stock market and the index locally. On the US side of things, we're seeing where there's a slight improvement in consumer confidence. However, on business side of things, index would have declined slightly month over month for September, and that's of course due to the Fed rate increases and the outlook for the US economy for the end of 2022 into 2023. Noteworthy there as well is that S&P 500 index, which is a broad index that measures, how stocks are performing in the US. Large stocks in particular would have fallen off significantly by 25.25%. And when you compare that to how Jamaican stocks are performing, then you realize immediately that, US stocks aren't doing as well as our stocks are doing a lot worse. So I want to zero in a bit on some of the trends that we're noticing in the stock market. As I would have mentioned earlier, there have been some pullback in prices, particularly for main market stock, and this is expected to continue over the near term as high inflation and the resultant high interest rates, tight monetary policy impact demand for stocks. We, however, expect that there will be some increase in capital market activity, and we've been observing that trend, particularly on the stock market, the equity market side. So we remain moderately optimistic regarding new companies listing on the JCC. With the rise in interest rates, we notice that debt financing has become very expensive, and more companies are turning to the equity markets for financing. So we still expect some level of dynamism in the equity market, both from a public and a private perspective, which will see more companies seeking that type of financing over debt financing, given that cost of debt is much higher, and then equity offers a bit more flexibility in times of uncertainty. We note as well that the JCC is offering a new service, and that is they'll be launching a short selling service in the near to medium term, and the service will likely drive active participation from investors as short selling provides additional risk protection for investment portfolios, given that it allows managers, portfolio managers, to be able to hedge long-term, their long positions, by doing short selling as well. On the fixed income side of things, as mentioned earlier, interest rates have been going up, and we are seeing that on the money market instruments. Those would have risen quite significantly with the recent BOJ rate hikes. We are seeing it as well in the local treasury bills as well. Investors are therefore able to get relatively high returns for low risk and very liquid money market assets. And a lot of them are piling into that. And that's why we're seeing somewhat of a retreat in the stock market. At the same time, we're observing that bond prices generally are depressed. There is a relationship, an inverse relationship between bond prices and interest rate or yields. And so with higher interest rate, you find that bond prices tend to take a hit. And we're noticing that one broad index which measures how emerging market bonds are performing is the EMBI index, and that has gone down by 31.9% year to date. So that's a significant decline. And we're talking about bonds within the Caribbean issued by governments and corporates in the Caribbean region and the global market. We're talking about Latin American bonds and other emerging market countries. These prices continue to be depressed by high inflation, aggressive central bank tightening, the energy crisis in Europe, lockdowns in China, and the controversial fiscal decisions in the United Kingdom. We know that the cost of new issues, it continues to be prohibitive, not just locally, but also internationally due to the rising interest rates. There are opportunities within the rising interest rate environment. However, so for our clients, we know that the rising interest rate, previously issued bond prices would have fallen off. Would have previously issued bonds, their prices would have fallen off. And so that presents an opportunity for persons to be able to buy instruments below par. And in particular, I emphasize that these instruments need to be of good fundamentals. You need to be comfortable and sure that this company doesn't have any fundamental issues when you're buying into it. All right, and that will create the opportunity for you to be able to realize some capital gains. In addition, there's a preference for USD assets we've noticed as well, over GMD assets, due to the view that local bond yields do not properly compensate for the level of inherent risk, right? I think the BOJ in their last update as well would have highlighted a concern as it relates to local interest rate that's on assets not being going up fast enough relative to what has been observed in terms of US these securities, and that may pose a risk in terms of the exchange rate dynamics in Jamaica relative to the USD currency. That is it from me. Appreciate everybody listening. I'll turn back over to the chair.
Thank you. Thank you very much, Tamar. Remember to stop sharing your screen. Thank you. Excellent presentations, both by National Commercial Bank and NCB Capital Markets, laying the foundation for what we expect to be a vibrant last quarter of the year. Further, also laying the foundation for our main presenter and the man of the moment, Mr. Don Anderson, Executive Chairman, Market Research Services Limited, who will now present the results of the third quarter business and consumer confidence indices survey. Over to you, Don.
Thank you very much, Andre. Let me say good morning to all the panelists and all the audience. As usual, we will just give you a bit of background, but let me begin my screen share. Here we are. Here we are.
Yes, we're seeing it.
Okay, great. So let's talk to you in terms of the fieldwork dates. We got into the field on the 1st of July, and we were out of the field on the 15th of September, 2022. The usual 600 consumer sample, household sample, and 100 business sample. We followed that same guideline. We would have obviously, in a way, prepared for challenges in the field, and therefore we overfilled in each case by about 10%. So the eventual sample in each case would have been more than factored for originally. So we interviewed about 648 persons and just over 110 businesses. Now, what is the data saying? In my view, when I look at both the consumer data and the business data, it reminds me of being on a very long flight to Australia or London or someplace like that. And we go through a fair degree of turbulence, which I equate to be the COVID-19 pandemic impacts. And then after a pretty strong period of uncertainty, turbulence, and some people sleep through turbulence, some people are anxious about it, whatever. But eventually, you break out of that. You see clear skies. The plane settles down, and people begin to think positively about the future. And that's the parallel that I have in terms of how the data looks for this particular quarter. Because we've come out, apparently, so the data is saying, of the pandemic and its challenges. And there's a considerable degree of optimism going forward. And the third quarter data does point in that direction. So let's look at what the data says. And we can see that, let me see if I can get the, right, 1 second. Yes. Okay, there we are. So what this says is that the last quarter's overall consumer confidence, and we will deal with the consumer confidence first, was up by 4.2 percentage points. So the consumers are more confident now than they were in the second quarter. We can see the pattern from 2001 all the way to 2022, and that shows a pretty jagged kind of reading on consumer confidence over the 21 years. But the last quarters are the ones that we really want to look at. And it says that consumer confidence is up by 4.2 percentage points in the third quarter of 2022. So let's look at some of the factors that contributed to that. So we asked consumers to give us a reading on how they saw current business conditions and current jobs. So this is what we're looking at now in this particular chart. And it says that in the third quarter of 2022, 14.3% of the consumers, of the 640 odd people we interviewed, felt that current business conditions were good. And this was an improvement from 10.5% over the equivalent period in 2021. So that's an interesting and important change over that period, right? What are they saying about current jobs? But even before we go to current jobs, let's look at the corresponding period, corresponding situation in terms of how consumers view current business conditions. In the third quarter of 2021, 33% of the consumers felt that current business conditions were bad. That fell to 22% in the third quarter of 2022. So that matches up and strengthens the whole view that current business conditions from the consumer's perspective are actually better than they were at the same time last year. What about current jobs? Because this is an important factor that obviously for consumers, they tend to look at to see, well, what are they likely to be able to do with disposable income? In the third quarter of 2021, 5.9% of the persons that we interviewed said that jobs were plentiful. Consumers have never ever felt that jobs were largely plentiful. But here, 5.9% said jobs in 2021 third quarter were plentiful. That moved to 9.1% in third quarter of 2022. And obviously there's a corresponding decline in the number of consumers who felt that jobs were in short supply. 71.7% in third quarter 2021, down to 51.2%. That's a significant fall off. And what's interesting to note in that middle block, those who consider current jobs to be adequate, that moved from 22.3% in third quarter 2021 to 39%, almost 40%, a significant jump who thought that jobs were adequate. So let's look at other pieces of data. What about current business conditions? We just looked at that, but what about expected business conditions? Because it also talks to you in terms of where the minds of the consumers are. That also moved up significantly from 27.8% to 34.4%. That speaks to those persons who felt that business conditions are going to be better. It also talks to you in terms of those who thought the situation was going to be worse, and that number fell from 32.8% to 23.4%. So again, we're seeing a buildup of positives in terms of how the consumers view business conditions and how they expect business conditions to be. What about the job situation? Bear in mind that consumers have never been positive, strongly positive about job situation. But in third quarter of 2021, 25.6% felt that expected job situation to be better. That moved up to 35.2%. So we've seen a continuation of positives in the minds of the consumers. That is also strengthened by the number of persons who felt that the business expected jobs to be worse. That fell from 38%, 39%, almost 40% in third quarter of 2021 to 25% in third quarter of 2022. So we're seeing year to date significant shifts in how consumers are looking at the whole situation. So what impact is it likely to have on household income? And we're taking a broad perspective because we do have data quarter to quarter, but we want to look at it in the broadest perspective, just in line with that parallel kind of, situation that I presented in terms of coming out of the pandemic and how people are viewing. So we're looking at a year situation for the first part of this presentation. 30.5% in third quarter 2021 thought that their incomes were going to increase. That moved to 50% in the third quarter 2022. So generally what we're seeing is a significant strengthening in the confidence level that consumers have. Correspondingly, all the other data falls in line with the other two pieces of information that we just shared. 17.8% felt in third quarter 2021 that their household income would fall. That fell to 10.7% in the third quarter of 2022. So with all that kind of positive that we see in building up year to date, from third quarter 21 to third quarter 22, what impact is it likely to have now on people's plan to purchase? We note that there has been marginal increase in purchase plans. And let me say that it is a very important piece of data because what it says is that although consumers are more buoyant and more confident about the economy, they're also recognizing that there are constraints that need to be applied. So let's look at the bottom figure, vacation. In the third quarter of 2021, 25% of all persons said that they were likely to take a vacation. That moved up to 29.3%. What about motor vehicles? The increase is larger than the incidence of persons who say they will take a vacation. 11.6% in third quarter 2021 moves up to 17.8% in third quarter 2022. Now, these are the more, I guess, the lower hanging fruits. Because when you look at home purchase, that fell from 10.6% down to 8.8%. Okay? We're not sure if any of them are in Clifton in St. Catherine. But the point is that in terms of motor vehicle, in terms of vacation, that consumers are indicating that they have a greater propensity now based on anticipated changes in their household income and their overall standard of living, that they would be in a position to buy, or they will making plans to buy a motor vehicle and plans to take a vacation. Not so with home purchases, that fell. So what does it say to us overall? We're looking at the trend in terms of consumer confidence, and we tend always to look at the 5-year trend. That's as far back as I think it is practical to go under the circumstances. We notice that year to date, for the 3 quarters of 2022 so far, this has indicated that consumer confidence has grown to 158.5, up from 140 in 2021. And if you wish, getting closer to the peaks of 2018 and 2019. The peak over the 21-year period that we have been monitoring this piece of information, or this confidence level, has been 180.2 recorded in 2019, just before the pandemic. We noticed that it fell in 2020 to 150, fell further in 21 to 140, but there's been a noticeable increase to 158.5% so far in the 3 quarters recorded for 2022. It's a very positive indicator, very positive. We just want to reflect on those who said the economy would get better and those who said the economy would get worse. And we want to look at the reasons why. So just to see if there are, from the perspective of the consumer, really concrete bases for their thinking. So we noted that 34% of the persons we interviewed said that the economy would be better in the next 12 months. So what are they talking about? The most important, these are listed in terms of the priority they assign to the factors. More business sectors are open. So consumers are recognizing that businesses are opening up, the economy is opening up, and this is the most important and largest single reason they gave. They're hoping things will improve. So they're not feeling it yet, and which is probably why their purchase intentions are kind of constrained. They're not feeling it yet, but they're hoping things will improve. They believe the economy is recovering. That's the third most important reason they gave for saying the economy will get better. Fourthly, the COVID threat has been reduced. So people are seeing things returning to normal. And I think this is one of the most important factors. And finally, they have some trust in what is happening around them in terms of some government policies, etc. So these are the top 5 reasons that they have articulated as to why they see the economy getting better in the next 12 months. Fewer persons, 23%, indicated that business conditions would worsen in the next 12 months. And we wanted to know why. So we roll them the same question. Why do you say so? Most important is the high cost of living. Not surprisingly, people are reeling from higher prices because of, all kinds of factors, not the least of which, of course, is the whole question of the global chain supply situation. High crime rate, very important factor. And when we look at the businesses, we will see that this emerges as well. Government not doing enough for the economy. So there are those who believe that the government could impact the situation more. And then lack of employment. So this whole question of employment has always been there. So even though people are feeling more positive about job opportunities, they're still saying, well, we don't have the jobs to actually support what is taking place and support our own situation adequately. Okay. So these are the key factors. And it is important to note that more persons believe the economy will get better than those who think the economy will get worse. And all of this is consistent with how the consumers are thinking about their own situation, how they're thinking about the business environment, and how they're thinking about the economy. So all in all, a pretty positive reading from the consumers. Having said that, we asked consumers, well, how do you think prices compare this year compared to last? And 87%, just about everybody, 9 out of 10 that we interviewed said prices have increased significantly. So this is the challenge, the main challenge that consumers are likely to face, even though they're feeling better and are more optimistic and more confident about the situation going forward. They're telling us that they're facing a headwind in terms of increased prices over the last year, which they expect to continue. Okay. We want to move quickly into the business confidence phase of our presentation. We interviewed over 100 businesses, and they're spread across all types of businesses. And here's where we're seeing significant positive change in terms of the outlook on their own business, on the economy, and in terms of the general business environment. So business confidence grew by 18.3% over the last quarter. 18.3% over the last quarter. And again, we can see the pattern from 2001. We can see that whilst it is up to 147.4, it still has not yet come back to the peak of 2019, which was 151. But that kind of dramatic increase, if maintained, will certainly take us back to that level and perhaps beyond. We're speculating now in the absence of the data. So what are businesses saying at the moment? We will see that the data is actually pretty dramatic. 25.4% say that they expect current profit to be better than originally anticipated. And this is up from 14% same period, third quarter, 2021. As a result, we see that in third quarter 2021, 43% of all businesses said that they felt that profits would be worse than expected. That number fell in the third quarter 2022 to 18.6%, a dramatic reduction. So in the middle of it, the largest single factors are that 55%, 56% who felt, well, it's going to be as expected. So that's the middle block. But it is worthwhile noting that there's a significant increase in the number of businesses that feel that their profits, or say that their profits are better than they expected. So is this a good time to invest? In third quarter 2021, 50.6% of the businesses said it was a good time to invest. That was substantially lower than it had been previously, because we've seen over the years prior to COVID that businesses were pretty bullish on the investment climate. We note in the third quarter of 2022, that number rose to 61%. So that bullishness is returning, and businesses are saying it is a good time to invest. 61% of them are saying it's a good time to invest and to expand. So we look at the data. We note, therefore, that last year, this time, third quarter 2021, 47% of the businesses said it was a bad time to invest. And that number fell to 29.7%, consequent on the increase in the number who said it was a good time to invest. So generally, businesses are also feeling pretty buoyant about where they are and their own future. So let's look at how businesses feel about the economy. And we can see the same degree of shift, positive shift, in all of the variables that we looked at, in terms of the firm's finances, in terms of their profits. So let's look at the first one. In third quarter 2021, 52% of the businesses felt the economy would be better, would get better. This is substantiated when we look at the third quarter of 2022, 55.1% say that they expect business conditions to get better. So there is a positive trajectory. And consequently, we can see that businesses are feeling better about the economy, even though the number who felt that the economy would worsen moved up marginally from 11.4 to 12.7. But that's counteracted by the increase in those who say the economy is likely to be better. What about their firm's finances? They're very, very, very positive about the firm's finances. In third quarter of 2021, 58.2% felt that their finances would improve. That moved to 80.5% this quarter, third quarter 2022. Okay, and consequently, there is a significant reduction from 11.4% on those who thought that their finances would worsen, down to almost zero. What about their anticipated profitability? That moved from 54.4% in third quarter 2021 to 71.2% in third quarter 2022. So again, we can see that businesses are very, very, very strong in terms of where they are right now, where the economy is going, and their chances for improving their firm's profitability and their firm's finances. What is the trend, therefore, in overall business confidence? We again see the same kind of pattern as we saw, as we evinced in the consumers, where the peak was 141.2 in 2018, dropped a little bit to 139.5 in 2019, dropped dramatically to 120.5 COVID year, picked up a little bit COVID year 2021, 124.9, but with the anticipation or with the expectation or with the belief that COVID is over or about to be over, that confidence level had moved up to 134.4% in 2022, a significant positive change. So we again look at the same kind of qualitative evaluation. Those who felt that business conditions would get better, we wanted to know if they really had concrete reasons for saying so. So we asked them, well, why do you think that business conditions are going to be better in the next 12 months? 55% of the businesses that we interviewed said, yes, it would get better. Why? They've been optimistic. So again, it's not that they're necessarily seeing the concrete changes yet, but they believe based on what they're seeing around them that it is a good time to be optimistic. They are optimistic, and that's the number one reason that they advance. Secondly, a lot of them believe that with the expected rebound in the tourism sector, that this will have a positive spin-off in the economy. Tourism being clearly our biggest, foreign exchange earner. And therefore, they expect that all of this will trickle down and that their business, regardless of what sector they're in, will in fact benefit somewhere or another. They believe the economy is recovering. So again, that's consistent with the thinking that things are opening up, businesses are coming back to normal, even if they're not coming back to full-time face-to-face work, but businesses are saying the economy is recovering, and as a result that they believe that things are going to get better. They see improvement in the production sector, and generally they believe that government policies are supporting all of this. So these are the 5 factors that the 55% who believe the economy is going to get better are pinning their hopes on. But 13% only, we say, compared to that 55%. So all of this is very positive. 13% believe that the business conditions will get worse. And as a result, we ask them, well, why do you say so? No surprise, crime. Crime has been a deleterious factor in terms of how businesses feel about the economy going forward. And it comes up again as being the number one challenge that businesses feel they will face in terms of moving their businesses forward. And this, remember, are of those who believe business conditions will get worse. They say crime is a major factor. They don't think that the economy will improve that quickly. So they expect slow growth, slow change. And this has to be noted. So they believe that things will move along, but it will not improve quickly enough to make a positive enough change in the short run. The instability of the foreign exchange. They're not talking necessarily about devaluation only, but instability, which means the fluctuations that they are experiencing. They can't plan efficiently. Continued price increases, which impact them and ultimately the consumers. And different factors. So here are the big factors. Here are the big ticket items in terms of why that 13% feel that the economy is going to get worse over the next 12 months. One of the important, really, all the charts are important. One of the ones that we introduced about maybe 8 years ago is this chart, which looks at, well, you say you're going to invest. You say it's a good time to invest and improve your capital outflow. Where is this likely to come from? And it's a question that was posed a few years back, consistently enough to us to take note of it and add this question so we can now say where and which sectors say they're likely to be increasing their capital expenditure and capital investment in the next year. We can see the 2020, 2021, 2022 year-to-date data. And what stands out is that 60% of the firms involved in finance, insurance, real estate, and business services say they intend to invest coming up this next 12 months. What's the next big sector? Farming and agriculture. This will be good music to the government's ears because they've been putting a lot of stress on improvements to the whole question of farming and agriculture. So 58.3% of those businesses involved in farming and agriculture say that they intend to invest. And this is followed by transport, storage, and communication, 53%, 54%, who say they plan to invest. And we can see that for almost all of the sectors, bar 2, there's a plan to invest. So we can see the positive changes going all the way down. The only one that is not in the positive mode, perhaps surprisingly, but there's been a significant upward pace, so to speak, in construction and installation, and 4.2% is a decline in terms of the incidence of business firms in construction and installation that say they're likely to invest. But the number is still high. It says half of them just about plan to do so. So there is a positive investment climate, and this data talks to you in terms of which sectors are the predominant sectors that say they will be investing coming next year or coming this current year. One of the pieces of information that we've been tracking since 2010 is the whole question of remittances, because it does impact how people feel about their ability to do things. We have found that over the years, the volume, the amount of remittances that are received in the country has played a very significant role in helping persons, primarily in the lower sector, primarily but not exclusively in the lower sector, to meet their daily household expenditure. And that has been pretty consistent up to 2020, 37%, averaging maybe about 37% all the way across from 2010 when we started to plot this data up to 2020. But what happened after 2020, or as a result of 2020 with COVID, is that the number of persons who say they're receiving remittances fell to 29% and has fallen further so far in 2022 to 25%. So a quarter of the households compared to 40% of the households almost over the preceding years are now receiving remittances. So fewer households are receiving remittances, which will impact, obviously, based on the information that they use the remittances to cushion their own financial situation, so that in a number of households, the situation would more than likely, especially given consistent price increases, be now a more difficult situation for consumers. Okay? Bearing in mind that they have used the remittances largely to take care of their daily living expenses. When we ask people if they save any of this, very, very few of the households that receive remittances are capable of saving any. The bulk of it is distributed in terms of household expenditure, sending children to school, feeding themselves on a daily basis, and taking care of their essential needs. Very, very little of it is saved. So when you see a fall off in the number of households, you can therefore match that with a concomitant increase in prices, and you can see that consumers, despite all the positives they're expressing, are likely to be feeling a greater pinch now than, say, 2 years ago. So we haven't plotted any COVID questions this time, except to say we wanted to know, well, what do people generally feel are the priorities the government should address based on what COVID has done? And here are the top 5 priorities. Reducing unemployment. So people are looking for jobs still. People are looking for jobs. They're not going to, the incidence of unemployment, of course, we see is something that is of concern. And it is saying here that consumers believe that this is the number one factor that should be dealt with, reducing employment. 2, focus on the country's health and well-being. Not surprisingly, we've come out of, or are coming out of, emerging out of a period of severe difficulty in terms of the impacts of COVID. 3, they believe the economy should be opened up further. 4, don't let up on the challenge of COVID. Don't let up on the effort to control the spread of COVID. And 5, notice, improving the education and the school system. These are the 5 things in order of priority that consumers feel the government should address right now, given the impacts that COVID has had on the country and on people in general. What about businesses? What are businesses talking about in terms of the government's action to address the COVID impacts? Getting the economy back on track. Reducing unemployment. So businesses are thinking the same way as consumers. Obviously, if they reduce unemployment, then more persons will have disposable income, hopefully, to be able to buy the produce that are being generated by businesses. Reducing government red tape. Always a problem. The businesses are saying, it's time we take a good look at the red tape and make a conscious effort to reduce it. Talk has been made time and time again about reducing government red tape. This is still on the table. is still on the table as the number 3 thing that businesses feel should be done to help them move forward. Improving education and the school system, very much in line with what the consumers say. So there are certain parallels going down the line. And of course, businesses talk in terms of reducing crime. So these are the top 5 priorities from the perspective of the consumers and from the perspective of the businesses that they believe government should tackle at this point in time. Okay. And I believe that that's the last chart that we have. So I would like to just pause there and obviously hand back to Andre. I believe that the data have been particularly interesting. I would like to say probably even exciting in terms of certainly the business sector and the dramatic change in confidence levels which the business sector has shown. So that, I think, is what I want to leave with you. Consumers are more positive, surely, but they're also pretty cautious in terms of their expenditure because, again, a lot of it is in terms of short-term jobs. So whilst they see the economy, short-term jobs, especially in construction, and we can see that not that the construction sector is likely to fall off, but these are kind of short-term jobs, and consumers are saying, whilst we believe that jobs are going to become more available to us, we are not going to necessarily just jump and spend because we're not quite sure how long it's going to last. And this is the sentiment that we're picking up, both in terms of what we've shown here and in some of the debriefing that we have actually engaged in from our interviewers' perspective. So thank you very much. I hope it made sense, and I hope that we can have a good discussion going forward. Andre, back over to you, and I'll stop screen share now.
Thank you, Don. Very, very encouraging, quite exciting results there. Business confidence up by 18%. Consumer confidence up by 4% quarter over quarter. I have a question early though. Normally, businesses are a little more cautious and the consumers are far more bullish. What happened this time?
You know, I anticipated this question. I don't know if I have an answer for it, but the bottom line is that, and I think I probably alluded to it in my last comment, that consumers are optimistic, and I think probably more hopeful than expectant, because I don't see them engaging in any new purchase to any great extent. They believe that things are going to change. They believe that jobs are going to become more available, not abundant, but more available to them. And it will give them some kind of relaxation in terms of the belt. But they're still pretty cautious about going forward. And I think this is a demonstration of good sense on the part of consumers, if you wish, right? Now, businesses, I believe, are beginning to breathe a sigh of relief, because I think that they've seen the COVID situation vanishing, moving back, receding. And I think that having held their breath for so long and not been able to control their own destiny, I believe that they're thinking now that we are in a better position to drive things forward. And I think this is what is feeding the optimism of businesses, which you're quite right. They tend to be a little more cautious, more long-term in their view. But I believe for the fact that they have held themselves or been held in check for the last 2 years, now that they see things improving and things are returning to normal, so to speak, new normal maybe, that they believe it's a good time for them to drive forward, to recover, so to speak, from the last 2 years.
Right. And I also note that the consumers are less inclined to make capital investments in terms of housing, etc., but more inclined to travel and take vacations and such like. So that's a cookie for Solomon Shab right away in terms of tourism and entertainment, for sure.
Right. But obviously because of the fact that, you know, travel has been severely restricted over the last 2 years, now that it is opening up, people are beginning to look at going to look for relatives and so on that they haven't seen in a while, except right. Maybe on, you know. So I think this is what is feeding that. And of course, the motor car market has been particularly buoyant, with the banks being pretty active in this regard. So I think those are the 2 areas. But in terms of, as you rightly say, the heavy capital expenditure like housing, which is probably for the moment they consider to be out of their reach, I think this is what is inhibiting that intention to purchase in terms of houses.
One other question for you before I turn to the panel. When else? I mean, we have 20 how much years? 21 years almost of data here now.
Yes.
Do you recall another period where we had such a drastic quarter-over-quarter switch? And if so, if you can recall, what was the macroeconomic stimulant at that time? Because I really am a little I'm presently surprised, but I just can't remember what may have happened in the past that would have been similar so that we can predict what may happen next.
Well, if we took a good look at the long-term charts, the 2001 to 2022 chart, you will notice there are two massive peaks. So yes, there have been periods where a quarter-over-quarter change has been dramatic. But you know what those years have been? Election years.
Oh boy. Okay.
Yes, yes. Those are, you can see huge peaks where people are responding to election promises and the confidence level grew substantially. And then within 6 months, when most of those promises were not fulfilled, confidence fell dramatically. So you see two huge peaks around about 2007 and 2011. All right. The data levels off after that, because as we can see from the data, what happened was that there was a greater degree of control of our finances between 2011 and 2016 and going forward, with the harsh IMF realities. So that there was a lot of belt tightening, but there also was less of a response to promises made in elections. So that period 2016, 2011 forward has shown less volatility, so to speak. But in the 2007, 2011 period, there are huge peaks. I mean, like cones going up because of the election promises made and responded to, and the election promises unfulfilled, which then resulted in a fall off in confidence. So the dramatic peak. So those two, yes, but it wasn't any macroeconomic factor. It was political factors.
Political factors. So this is definitely some kind of an anomaly then that we haven't seen in 20 years.
Absolutely. Absolutely. And what we've seen since 2011, basically 2012. So, and we talk about that period of difficult IMF conditionalities between 2011 and 2016 and how the government responded to that. And I think since then, there has been a kind of, if you wish, maturity on the part of the consumers, particularly in terms of how they view the whole situation. So where we are right now, this in fact is an anomaly. It's a dramatic change over the period. And I think what has been the intervening factor, COVID and the impacts and the breathing that people are now beginning to breathe a little more easily now that they see COVID receding, hopefully ending.
Right. Thank you very much, Don. Very, very interesting, very positive. The headline for those just joining is that business confidence is up by 18% over the last quarter, consumer confidence up by 4%. Okay, question for the panel now. Start with the veteran panelist, Dr. Marlene Street Forest. Business confidence up by 18%. From your shop, from your area of your side of the table, are you seeing this in terms of the businesses that are seeking your services? One, and two, your own opinion on how to interpret these results.
Okay, definitely. I'm pleased that business confidence is up, because obviously this will translate well for the capital market and especially the equities market. And in light of the fact too that one of the results is that the companies are expected to invest more in their businesses. So we're seeing this as a positive, despite the fact that interest rate, and especially the fact that interest rate has gone up. We believe that that will translate well in terms of the stock market and persons demanding from the supply side financing for their businesses. Coupled with that, we believe that from the standpoint of the investor, despite the fact that, and I heard Dr. Gordon and Tamara speak about sort of moving out of the equities market into other funds because of interest rate. I believe that we will see in the medium term companies, investors coming back to participate in some of those IPOs that I have no doubt will be coming on stream shortly for financing. So all told, I think that there is a positive message in what we are hearing, both from the standpoint of the investor who can reap benefit from the market, and from the standpoint of the companies that I think will be seeking financing. We are seeing just a slight dip, as Tamara said, in respect to the main market. But if you would note in respect to the junior market, which is where I figure that we will see more small and medium-sized companies trying to access financing, you would have seen that it's double-digit in terms of when you look at the index and the performance of the index. So all told, I think the results are positive for both the companies and for the investors that will seek to buy into these companies.
Thank you. Thank you very much. Don, you alluded to the business confidence being where it is, and one of the primary contributors was tourism and entertainment. Am I correct?
Yes, that was what we picked up.
Okay. Okay. All right.
And the reason that this is important is that they were saying that with the tourism dollar coming in, this would redound to the benefit of other sectors, not directly immediately, but that it would in fact condition better all-round economic improvements.
Okay, well, that certainly supports Dr. Forrest's point. I mean, if we have BOJ last week said consumer prices have fallen off in the month of September. Statin is saying that employment is now close or at post-COVID levels. And now you are indicating that business confidence has skyrocketed. So, Dr. Forrest, I guess the next thing we have to expect then is a turnaround in the stock market, or is it too soon to go there?
No, I think you're gonna have you'll see that turnaround in 2023. Remember, it's not all down, the main market, but look closely at the junior market where you see that tourism, I suppose Solomon will be talking about entertainment, etc. So you can see that there is a definite correlation between, the consumer confidence and business confidence and those areas of business. So you will see generally, and it will lift all boats. So we should see an improvement in the composite index in next year.
Thank you. Thank you very much. Mr. Solomon Sharp, consumers indicate that they're not buying any houses, but they're willing to entertain themselves, take vacations and travel, etc. Based on where you sit, sir, how do you see these results? Do these results support what you're seeing on the ground, and what is your opinion on the medium-term prospects?
So we are very positive on the medium term. Basically everything that was echoed this morning by Don, we see things moving in that direction. Remember, there are two types of tourism. There's a diaspora coming home, and then there's the traditional tourists. As it gets colder, we'll see the demand increasing in the US, and that whole pent-up demand is also there. So what we've been realizing, we see a few weddings, destination weddings coming in that's bigger than normal. You're talking about 250 persons on the West Coast, and definitely the events that would have normally been held before that hasn't been that hasn't happened for the last 2 years. They're back. You see the likes of Sting is back. There are a couple of new entities on the market, and like I Love Soca would have become more dominant. So we feel very positive. We just hope that some of our suppliers, like the liquor suppliers, etc., can fix their demand, their supply issues. And I think once those supply issues are fixed, they, based on what we're seeing with the consumers being positive, it's all positive for us. I wish I had some low interest money right now. I'd like to get $500 million to expand main event, and so I feel that confident about it.
Dr. Gordon, an opportunity there for you. But what about given the you mentioned suppliers, Solomon? Given the steep increase in prices, will the have you seen any elasticity in terms of the cost of events to the consumer? You appear to be still bullish, but given the price increases, will people be able to afford the events? Or is it that they are not responding much to the price increases and they're full 100 going ahead despite?
So they will respond positively to any price increases. Once you're giving our consumers quality, that's when they'll show up, and that's what we've realized. The promoters or the persons who use main events, shameless plug here, for their executions, we've seen that they've paid more. The promoters have paid more. They've come out very happy. Their consumers are happy, and they're playing the long game. And in business, you always have to play the long game, and it's working for the promoters. They've come back to us and they've said that they're very happy with our executions, and that their consumers are very happy. So they're pretty much making the same amount of money. They may have had less persons, and the less persons that they had was not as a result of the more prices that they charge. It's just the whole cycle changed, and certain persons were just adjusting to the whole new schedules. But they've made as much or more money on less persons, and they had to take that price increase. In my sector, we have to look at a price increase. There are certain elements that we used to be able to provide that, we bought a stage deck before for $500 US. That same stage deck is now $1,000 US dollars. It's certainly more difficult to get around with the gas prices, etc. So, my clients do complain about that, but they do come back that it's a harsh reality. But I think you'll see some sort of adjustment. And again, the most important thing to anybody who is distributing any product, whether it's a party, a concert, whatever, just give our consumers quality. And once you give our consumers quality, they'll be there to support you day in, day out. Thank you very much. So from your own plans then, I mean, in the survey indicates that businesses are planning significant investment in 2023. Would your company be in that bracket? Most definitely. We're looking at a couple projects. Luckily for us, and it created nervous moments during the pandemic. We had made some significant investments, so we were a little bit ahead of the curve in terms of some of those assets, and those assets not going into ruin during the period, the downtime. But we're also looking at some other opportunities to invest more. As I said, if you know where there's some low interest money at about $500 million of low interest money, you tell them to call me. So we're going to be aggressive and remain nimble and agile and look for all the opportunities. We have looked overseas, but we don't think that the Jamaican market is quite yet satisfied with what we have done, and we think there's more scope for growth here. And we're also looking at some overseas opportunities. Okay, excellent. Since we're doing shameless plugs, APO is a consideration as well here. Yes, well, definitely. All right. We're looking at all options. Great. All options. The businesses are bullish on investments, so we expect that across the board, all finance options will be available, will be considered. Mr. Marcus Richards,
Executive Chairman, Argyle Industries, and Managing Director of none other than Hardware and Lumber. What is your take on the business and consumer confidence results? And where are you seeing, does what's happening on the ground with you and your organization corroborate what Don presented?
Good morning, Andre. Just a quick correction. I'm the executive vice chairman. My chairman, Chris Movell, would not appreciate me trying to assume that title.
Yeah, that's my fault. Sorry.
Yeah, no problem. I'm very much aligned with everything that has been said, not only by Don, but also, you know, Marlene and Solomon as well. I would say, much like from my standpoint in terms of the businesses that I am connected to or operate, I would say cautious optimism is the absolute call. And, you know, one of the things that we haven't spoken about that I think is of perhaps great concern to businesses like me that have a, you know, diverse supply chain. I mean, we have over 300 suppliers, many of which are, and that's just in H&L, many of which are overseas. I'm very much concerned about the geopolitical state of things now, and much more concerned about that than I am inflation. I'm watching inflation, but to Don's point, inflation is something I think we are more accustomed to dealing with, and we're coming out of a really tough 2 years, and to go up against something like a global pandemic was not in our toolkit when we looked in. So coming out of that is definitely a huge sigh of relief, a breath of fresh air, and now to tackling some of the other things that we can manage. Now, as far as optimism goes, I think that for better or for worse, once you're in business, worse if you're an entrepreneur, optimism is your calling card at all times. And the question is, where there's always something that can be pursued and something that can be achieved. The $1 million question is what and where. And so, for example, where Don had spoken to investment, yes, we are making investments. We are looking, just like someone said, at projects, but the size and scale of the projects is a little smaller. Where we are focusing our investments is actually on becoming even more agile. I think we have learned coming out of the last 2 to 3 years, the importance of agility, the importance of efficiency. We are responding to changes in consumer appetites, changes in consumer behavior, changes in a lot of things. So, you know, nimbleness, agility have become new calling cards in business, definitely in Jamaica, because much of what we have to deal with is not the same as, for example, our US counterparts. Supply chain disruption in the US is very different from supply chain disruption in Jamaica. We have 1 or 2 more steps that we have to navigate versus our international colleagues. So interesting time, but to really answer the question, I endorse everything and support and align with everything and across our businesses. And it's important, I think, at this time to be diverse. And I'm grateful that our group has lots of those elements to it, but cautiously optimistic. Yes.
Okay. So all the panelists have really said that their consumers, their positive business-wise, and their own customers are also responding positively. So from your perspective, we see among the leading sectors for growth, construction, it seems to have fallen off from its usual high point. Am I correct, Don? But Marcus, you're still seeing robust enough activity from your consumers to indicate some level of confidence in that sector as well.
Very good question, Andre. So we, over the last couple of months, as is to be expected, have seen some slowdown in traffic to our stores. And for all of our guests here, Hardware and Lumber has interest in home and hardware through Rapid True Value, where we are a retailer of home and hardware products. We are also, through hardware and lumber wholesale, a wholesaler of many of those products. We have H&L Agro as part of our portfolio, and we are in that space a retailer and wholesaler of farm and garden supplies, and we have interest in other things. So I spoke to the benefit of diversification. So where we have seen some contraction in retail traffic and perhaps retail spending, we are seeing shifts to other things. And that has not caught us by surprise, because as Solomon and Don indicated, once the economy opened up, and more importantly, the industries of entertainment and hospitality, and I use them deliberately in that way in Jamaica, we've seen a shift in the direction of spend, as is to be expected. And like everybody else, we continue to watch how that plays out, especially when you have the backdrop of inflation, which makes your dollar go a little less than it used to go. So these are interesting times. Once we get out of the pandemic situation, which is an entity all on it to itself, as I mentioned earlier, and we get back to some of these core fundamentals of what is happening in our economy, what our consumers are doing, where consumers are going, how they're spending money. That's where my confidence comes from, because in all of our businesses, we're very attentive to our customer base, their needs and their wants. And as I mentioned earlier, it's an eternal quest to make sure that we are meeting them where they want to be met, how they want to be met, etc.
Thank you very much. Well, the feedback from the panel so far, Don, is that your survey respondents are telling the truth. We have addressed the financial sector, the capital markets to some degree. We addressed the retail sector. We have addressed entertainment. And I'm happy to say that Nicola Madden-Gregg from the tourism sector is actually online. She's a director of the Jamaica Chamber of Commerce, and also, I think right now, chairperson of the Caribbean Hotel and Tours Association. And Nicola, if you're there, I would ask you for a comment on these. Since this 18% is largely attributable to tourism, and your minister has been talking very strongly. On the ground, are these what you're seeing as well?
Yes, yes. So I'm not chairperson, but president of the Caribbean Hotel and Tourism Association. So, but thanks for having me. Yes, tourism in the Caribbean and also in Jamaica has rebounded quite significantly. We are actually now in Q3, we were still in recovery phase, but the Caribbean has recovered faster than any other destination in the world. For Q3, we were up 3% over the 2019 numbers for the same period. And 2019 was what we would call a record year in tourism. Just to give you a good example, total international inbound for Q3 was still down -39%. The Americas was down -24%, Euros -31%, Middle East and Africa -19%, and Asia Pacific down -72%, and the Caribbean was up 3%. For Q4, projections on the book, we are pacing quite well, and it is looking like we'll be up 15% in the Caribbean over 2019. So we have shifted from recovery into growth, and that's really quite significant. The question has been asked, is this growth sustainable? And the answer I would give you is that definitely. A lot of this growth is being driven by the US market, yes, but we still have Canada, the UK, LATAM, which has not fully recovered as yet. So they are yet to rebound to their 2019 numbers. We anticipate that we as a region, both the Caribbean and Jamaica, will be able to retain the business that we have gotten out of the US market. We do have adequate airlift throughout the region coming out of the main markets, but the Caribbean region in and of itself, though, in terms of interregional travel, is lagging behind our international arrivals. And there is a lot of push now to try and drive more regional airlift. So that also is lagging in the recovery. Where we are seeing also that there is potential for growth is that our meetings, conventions segment and our business travel segment is also lagging behind the leisure market. And so we anticipate in Q1 going forward into all of 2023, you will see a significant uptick in that segment. And so that will also drive the growth that we are anticipating in the Caribbean.
All right. What about cruise ships? Cruise ships generally benefit transportation, tourism, entertainment specifically, and small retail. What is happening in the tourism in that sector now?
The cruise segment is still not fully recovered. I would think with season starting, which is coming into season now, we will start to see some uptick in that segment. They still are having some challenges. There have been some consolidation of the number of calls, but we are anticipating that generally the number of actual passengers will remain the same, even though the number of ship calls may be reduced. So they have taken the time in the cruise sector actually to retire some ships and are working with larger ships. So instead of maybe a call with 1,500 or 2,000, you'll have larger calls with passengers. So we are anticipating that that will also drive those segments of the market, as you mentioned, particularly transportation attractions or craft vendors, or small, medium-sized tourism entities. And so we are definitely seeing that. The other area that continues to grow, of course, is somewhat the shared economy. And we are seeing that villas, apartments, and those other segments in terms of the accommodation sector are continuing to grow as well.
Okay, thank you very much, Nicola, for popping in. Given what we heard about what was happening in the results and the contribution of tourism, I couldn't help but have you say something here.
My pleasure, my pleasure.
Thank you for the input. There is a question in the chat, which I believe would have to go to our financial experts online. I would ask maybe Dr. Gordon or Timar to take this one. Given that we can expect a continued tightening of monetary policy, what are your views on the possible impacts on the housing market? Maybe Dr. Gordon would like to touch that one.
Sure. Yeah, very pertinent question. What we see from BOJ's policy actions is that we believe that they are largely complete with removing the accommodation that was inherent with the past few years and are in a stance of perhaps further tightening. The September outturn for inflation was marginally lower than previous. And I think by their next decision meeting, which is in November, there will be 2 more data points on inflation, which might inform the pace at which they move rates further. Still, we see where from that sense of monetary policy tightening, lenders are marginally increasing rates on mortgages. At NCB, we have publicly announced an increase in mortgage rates. But nonetheless, rates are at a historically low level. I think the more important factor for the housing market and its outlook, beyond the monetary policy rate, is the wealth effect that has occurred over the past 2 years from COVID and from tightening financial conditions, which is lower general wealth from a financial asset standpoint. When we look at, for example, the main market and its performance, down perhaps about 14%. When we look at capital markets overseas, the S&P, down 30%. When we look at the value of mutual funds and other wealth holding financial assets, what we're seeing is that generally households have lower wealth at their disposal. And we believe that will have a bigger impact on the outturn for residential market over next year than the actual pass-through of the monetary policy interest rate, which we know will occur with a lag. So we see where construction activity, for example, while still robust, it has slowed relative to previous years. And actually lending to the sector is actually growing at a slower rate. When we track actually the residential property price indices published by the BOJ, and we as well estimate our own residential property price indices here at NCB, we see that the housing market is still sound and robust, showing steady growth, but that growth is expected to moderate given the aforementioned wealth effects.
And that appears in Don's analysis as well, where that was the sector that would show a little bit of decline over the previous quarter. So that spells sense. Thank you very much, Doc. Timar, I think you said in your presentation, Timar, that, I mean, the truth is that the Jamaican capital markets have been quite resilient through the pandemic period, and even now, in compared to some other more established, more mature markets in the world. You indicated that there are some, I mean, there are stocks in the in foreign jurisdictions that are not doing as well as some of the companies listed in Jamaica. What sector of the economies were these in that the Jamaican companies are outpacing the performance of the companies in other markets? It's on you. Yeah, go ahead.
Andre, that's a very good question, and a very tough question for me at this time, because I would have to go and do some research in order to identify the specific sectors. I can speak to the broad indices,
Yes.
which I did. And I think Dr. Forrest did also mention the fact that we have, as a category within the overall index, the junior market doing well, right? We have seen the performance of recently listed junior market stocks. Some of them double-digit returns in a very short space of time, double to triple-digit returns, right? We continue to see that for some of the companies that would have suffered throughout the pandemic as well on the local market. Those would have developed impetus since the reopening of the economy, and certain factors that's related to the pandemic sort of peeling away, right? On the main market side of things, we see where investments are being made, not only capital investments and companies announcing major expansion plans, but you have companies, for example, separate, I would have done acquisitions across border, right? And we are aware of, other similar opportunities, either locally or across borders, both in the private market and the public market. And those activities are taking place, a lot more after the pandemic, but they were also happening during the pandemic. So I think from that perspective, Andre, my conclusion is that it's not necessarily a specific sector that's driving all the performance or the buoyancy of the local market, but it's the sort of decisions that the leaders, the private sector would have taken during the pandemic, the heights of the pandemic and after the opening of the economy, that's really keeping a lot of the stocks afloat and driving the performance of many of them. Because while we see the prices going up, I must say I'm pleased to see that in many cases it is justified, because the performance is also there to support it.
Okay, thank you very much. Thank you very much, Timar, for that answer. Didn't mean to put you on the spot, but I knew you're up to it. You work at NCB Capital Markets. All right, panelists, as we wrap up now, I just want to ask each of the panelists, if you're in a position, if there's one thing or two things that you would require from a legislative standpoint, from government, let's say, to jumpstart or further incentivize your sector of the economy for growth, what would that be? Marcus, I think you mentioned, Solomon, you mentioned the 500 million in cheap capital. We know about that one already, but anything else, Mr. Richards, that you would require, I mean, from a government's perspective in order to continue to stimulate growth in your sector of the economy?
Feel like Timar's response previously is the one I'm going to copy right now. But I think what without naming specifics, what I would say is that the volatility that we experienced over the last couple of years in the supply chain, especially in our trading businesses, I think that a review of duty, customs, tariffs, taxation rates, all of those things, I think is important, especially as an incentive to export-oriented businesses, and also the recognition that you know, when markets shift on you, some of these policies can be quite disastrous if you're not careful. And GCT is one of those that we had to dance with. And I'm sure that a lot of my colleagues in business who have to import things, that 5%, especially if you're in an environment where international prices are escalating away from you, leaving that 5% gap with government to try and recover in a challenged local market can sometimes be you know, I've seen a lot of companies that have been pushed to the brink just because of that, and the GCT recoverable balances that they have to carry. So it's something that I would not only ask that it be looked at, but I'd be happy to serve on any committee that we're looking at it, if there's anybody in government that's listening to this.
Excellent, excellent. Thank you very much, sir. Solomon, any comment on that? Or what would your industry require to further propel you forward?
Training. I think there are enough people out there that are employable, that want to be employed, but there's a lack of training. We have seen a lot of in the whole construction sector, you know, you're focused on residences, but we've also seen a lot of hotels that have been launched since, and a lot more hotel rooms in construction. So we are ready. We have a template ready to work with the government to set up an academy or any kind of a training facility for us to train about 300 to 400 Jamaicans that are needed in that in the whole entertainment sector. And it's important for tourism, and it's also important for the other possibilities that are coming up next year. There's a lot of opportunities in the pipeline. For argument's sake, the JEA show is coming up again. There's a big car show coming up in the early part of the first quarter of next year. So with all these opportunities, let us put all these people to work, and then that will help to get the economy back on track. It's not a 4-year degree that's required, so it's relatively quick and easy. Our Jamaicans are a lot more smart than we realize, and adaptable. So we have that template ready but we just need a little bit of funding with the government. You know, we did a M Academy before, it was a success. So we think we can train more Jamaicans and get everybody up and running, and get my business and other businesses in my sector up and running to perform at international standards.
Thank you very much. Excellent, excellent. Opportunities for private-public partnerships coming out here. Dr. Forrest, could I ask you that same question?
Oh, yes. Access to capital is key for economic growth and development. So obviously, one of the things that we would want the government to look at is increasing, as we have, we have put the proposal already in terms of increasing the capital that the junior market companies can raise at an IPO or an APO. And we want to see that probably happening quicker than the timeline that has been given. The other thing is that when you look at new asset class, etc., there is going to be a need for us to look quickly at how we change our legislations, or we improve the pace at which these can be approved. So these are some of the things that, you know, we could work with the government on. And I know that there has been a push to with the micro companies in terms of access to capital. And I'd love to see a way in which we can agree to a possible framework to allow for them to get access to equity capital as well. I don't think it is beyond us to imagine and innovate on that particular area.
Thank you very much. Thank you very much. Again, government, if you're out there, excellent opportunities for private-public partnerships here coming from some stalwart leaders in the private sector. Paul Media, I forgot to have you show the vox pop. We have a short vox pop, persons from the on the road actually giving their comments on the current state of business and consumer confidence and how it's affecting them. So in closing, I would ask that those clips be shown now, and then after that I'll do the wrap up.
Hi, my name is Venice Anderson Facey. I'm the Managing Director of Body Contouring by Venposh Spa. The present situation has improved. It has become better, and that's simply because I had to pivot throughout the last 2 years. I had to come up with, strategic ideas and had to pretty much add new things. So one of the things we decided to add to our establishment is the fact that we started to offer delivery services. So during the COVID pandemic, a lot of people weren't coming out. So what we had to do is have our bearers going out to them. So what I loved most about that is that NCB provided us with the portable machines. So our bearers usually take that along. We also got the tap feature on our machines in office. So therefore, when customers come in, there's actually no contact, as the COVID protocol suggests. So that is one of the strategies that we implemented, and it has worked. I did not send home any of my staff. I kept them all. And the industry that I'm in, which is body contouring, that in itself is something big, it's something major. So during the pandemic, a whole lot of ladies utilized that time to get their stuff done. And when I say stuff, I mean they went ahead, they did their surgeries. What we do here at Venposh, we provide the aftercare. So pretty much we partner with the surgeons right across Jamaica. So all these clients were coming into us during COVID. So while products were not necessarily moving because persons were a bit scared to come out, we had the services going. In business, you have to learn how to pivot. So what we had to do, we had to pretty much diversify our income. And the truth is, an opportunity came up for us in the middle of the pandemic, which is when we started Magic Touch Events. So Magic Touch Events pretty much provides services in terms of wedding events, corporate events, parties, whatever. So we provide things like 360 video booth. We also provide things like the fog machine, which is dancing on the cloud. So there's a whole wide range of things that we provide in the entertainment industry. So a lot of people were getting married in the pandemic because of the fact that the numbers fell to 50. So a lot of people utilized the opportunity to say, okay, finally I can have less people at my wedding. So we had a whole lot of weddings during that period. So yes, it provided opportunities for us. And we also decided that we're going to go online with our Venposh business. What do I mean by that? I've now garnered, clients all over the world. So people are now shopping online with us. So as opposed to you being in the United States and feel like you have to come here to get what we have to offer, we started offering shipping. The workforce lesson I learned during this whole COVID period is just don't fold, right? Not because there is a crisis happening means that you should just shut down, give up. You have to figure out other ways in which you can now start marketing your business. So one of the things I will say to you is that social media became a huge part of our business. So we literally started to get on every single social media platform because truth be told is that is where all our customers are. So we have a niche. Our niche is women who wants to look beautiful, women who wants to enhance, and they're on social media searching for us. So if we're not on social media, they won't find us, right? So I just want to encourage every business person out there, get on social media. Well, I'd love to say to persons, don't give up on your business. I didn't start here. You're looking at an establishment that is pretty much providing goods and services throughout, the beauty space. But this is not where I started out. I started out selling accessories. I started out selling hair. I started out selling clothing. That did not work, but I did not give up. What I did, I decided that I'm gonna have to find something that is gonna solve a problem. So what I found is that many women are very self-conscious. They want to look better. So what better field to get into the beauty space?
The present situation with the economics is a very tight, because what you really have is people's spending power is very limited. So you find that the wide variety of goods, people usually buy 10 or 1 things first. President will not buy more than 5 because of the economics situation and the spending power. That have a great effect on consumers and all.
COVID-19, that pandemic affects a lot of people. And it affects me also. Change work from work to work. It's a bit difficult at the moment, but we are hoping. We have a lot of work to do, and only what we're having, the problem we are encountering now is the cost of materials we use and work, like Amara, tire shine, degreaser, diesel. We buy diesel, we use diesel to wash, and some other things like we use and work. And enough work, but no money to buy the materials due to the materials are expensive.
Our working skill, our working attitude, and basically everything because of impact of the lifestyle and how the economic running. So a lot of changes being made.
Yes, changes, things getting slow, a little changes. So slow, but things looking up right.
Subsidy for the poor set then get to more a living because the restriction really overthrown a lot of people suffer from it.
The COVID do a severe blow to the economy, and the changes are very vast amount of changes. Because basically your lifestyle change. Basically each and every person lifestyle change. Some change for the better, some change for the worse. But you got to try to handle it the best way you can.
All right, thank you very much. Perspective from an entrepreneur and from small sector, medium sector, and micro sector as well. Well, I just want to wrap up. I want to thank you all very much, all 100 of you, for staying with us through this presentation, plus those on YouTube. I thank again our sponsors, National Commercial Bank, NCB Capital Markets. Thank you to the panelists. I think we had a very robust and insightful and encouraging discussion from all the panelists. Dr. Marlene Street Forest, Managing Director, Jamaica Stock Exchange, Mr. Marcus Richards, Executive Chairman, Argyle Industries, Executive Vice Chairman, beg your pardon, Argyle Industries, and of course, Managing Director of Hardware and Lumber, and of course, Solomon Sharp, CEO of Main Event. Thank you, Don Anderson, for the excellent work once again. Very insightful. Thank you to Timar and also to Dr. Gordon for providing your inputs as well. We look forward to your continued participation and support. And on behalf of the Jamaica Chamber of Commerce, I thank you for joining us, and please remain productive and have a great week.
Thank you.
Thank you, Andre. Gentle reminder that Nicola is with us.
Yes, I
Thank
thank
you.
Nicola already, man. Thank you,
Okay.
Nicola, for your impromptu show up.
Thank you, guys. Not a problem.